Welcome back to Accounting 101. We're on our last chapter for this semester, Chapter 12, and we're going to be talking about the statement of cash flows. Our learning objectives for this chapter is to discuss the usefulness and format of the statement of cash flows, prepare a statement of cash flows using the indirect method, and analyze the statement of cash flows. This is the last chapter, and we go through it kind of quickly. You'll be thinking about the final, but cash flows are very important. And as you go through different classes, thinking about cash flow and um, how the cash is impacting the business and how it's going to impact the cash flow statement is very important, even if you're not an accountant. Um, Again, having the knowledge of what's happening as you're um, making decisions for the business is it's very important to understand how it implicates cash. And it's a little bit confusing. For some reason, um, even good accountants struggle with cash flow and how to do it. So hopefully, as we go through the chapter, I can break it down and give you some hints on how to think about it and how to make it easier. So the statement of cash flow reports cash receipts, cash payments, and the net change in cash from operating, investing, and financing activities during a period. The information helps assess the entity's ability to generate future cash flows, the entity's ability to pay dividends and meet obligations, reasons for difference between net income and net cash provided or used by operating activities, and cash investing and financing transactions during the period. Cash flow statement has three sections. There's operating activities, investing activities, and financing activities. The operating activities is where we'll see income statement items. So as we think about the income statement and things that flow through the income statement, we're going to explain the cash flow impact of that in the operating activities section. The investing activities is cash flows resulting from changes in investments in long-term assets. So again, these are investments that the company is making, not investments in the company. So think about property, plant, and equipment, the plant assets, that section that we talked about all goes through here. If a company invests in another company, buys their stocks or bonds, it goes through here. And then finally, the financing activities. It's cash flow resulting from changes in long-term liabilities and stockholders' equity. So this is how we finance our business. So issuing bonds, issuing common stock, paying dividends to our shareholders, that type of stuff goes through the financing activities. So it's long-term liabilities section of the balance sheet and the stockholders' equity section of the balance sheet. And here breaks it down for the types of things you would see in each section. So under operating activities, again, we said it's income statement items. So inflows are sale of goods and services. And you'll get, if you receive interest or dividends, then that will go in the cash inflows for the operating activities section. Cash outflows, if you pay suppliers for inventory, you pay your employees their wages, you pay taxes to the government, you pay interest to lenders, any other expenses that you're paying for, that'll be the cash outflows. Investing activities, again, changes in investments in long-term assets. So if we sell any property, plant, and equipment, if we sell investments in debt and equity securities of other entities, if we collect principal on loans to other entities, so we issue bonds or that type of thing, and they pay us back. Cash outflows, if we purchase property, plant, and equipment, we purchase investments in debt and securities of other entities, and if we make loans to other entities. So if we set up that notes receivable that we talked about in Chapter 8, it would show up here. And then financing activities, it's changes in long-term liabilities and stockholders' equity. So if we sell common and preferred stock, if we issue debt in the form of notes payable, bonds payable, that type of thing, the cash inflows will show here. Cash outflows, it would be paying dividends to our stockholders, if we redeem long-term debt or reacquire capital stock, the treasury stock that we talked about in the previous chapter, those cash flows would show up in the financing section. Then there can be some significant non-cash activities. So there could be things that the business does that doesn't impact cash. So if we issue common stock to purchase assets, that's a non-cash activity. So we looked at that when we talked about stockholder equity and the transactions there. If we issue it to purchase land, or we issue stock to pay for an invoice, that type of thing, that would be a non-cash activity. If we convert bonds into common stock, so when we talked about bonds, we said they could be convertible into common stock. If that happens, no cash changes hands, so we just put it as a note to the financial or to the cash flow statements. Issue debt to purchase assets. So if we issue bonds, a mortgage to pay for land or a building, that again, non-cash transaction. And if we exchange plant assets, so we can exchange it. So if we have a machine that we're not utilizing and another company has a machine that we want and the same value, we could just exchange it and no cash changes hands. So we're going to do a separate schedule at the bottom of the statement, for example, or in the notes or supplementary schedule in the financial statements, we could see that information on non-cash activities. So net income is not the same as net cash provided by operating activities. The table below shows some results from recent annual reports. These are in millions, including Target. So note how the numbers differ greatly across the list, even though these companies engage in retail merchandising. So Kohl's had reported $889 million of net income, but they had $1.9 billion of cash provided by operating activities, so $1 billion more than their net income. Walmart, they had was at 9 billion more in cash provided by operating activities compared to net income. JCPenney, pretty close, a little bit more cash out with the net loss. Costco, $20 billion in net income, but only $3 billion in cash provided, so a lot less cash provided by operating activities than their net income. And then finally Target, $2 billion of net income, but $6.5 billion of cash provided by operating activities, so generated more cash than what their net income was. So why the differences exist? Simply the timing of reporting of revenues and expenses under accrual versus cash basis. Remember, way back earlier in the year, we talked about accrual basis and all the adjustments we have to do at the end of the period. Accrual basis is GAAP, but it's not cash basis. So there's going to be a difference just because of the timing. So if we sold a lot of stuff in one year and then collected the cash in another year, our cash collected could be higher in year two than year one. So that type of thing. So remember, accrual accounting, we report revenues when the performance obligation is satisfied, even if cash hasn't been received. Expenses, we report when they're incurred, even if we haven't paid the cash. So that timing difference is going to explain why our cash from operating activities is going to be different than our net income. Again, the order of presentation on the cash flow statement: operating activities are first, then investing, and then financing. Under the operating activities section, there's two methods we can use to generate that section. We can use the direct method and the indirect method. We're going to go through all the examples of the indirect method. It's the most common, and we'll explain a little bit of the differences in a couple slides here. So here's what the statement of cash flow looks like, the format. Again, we have the company name and the title, name of the report, statement of cash flows, and then the time. So it's for the period cover. So it's the same as your income statement. So and the retained earnings statement. So if they're for the month ended or the quarter ended or the year ended, you would present the cash flow statement based on that same period. It would be the same date in that title. Then we have the title cash flows from operating activities. We're going to list the items, get a subtotal there, and it will be net cash provided or used by operating activities. So if it's provided, it'll be a positive number there. If it's a negative number there, then it's going to be cash used by operating activities. Next section is the cash flow from investing. List the individual inflows and outflows again, get a subtotal. Cash flow from financing, same thing. List the individual items, get a subtotal for that section. We add those three up and we get net increase if it's positive, or it's a net decrease if it's negative in cash. We then add that to our cash at the beginning of the period, and we will get our cash at the end of the period, which should match what is on our balance sheet for the end of the period cash reported there. Then again, if we have any non-cash investing and financing activities, we can show that at the bottom of the statement. We'll just list those individual transactions. So we'll now look at some transactions and identify whether they're which section of the cash flow statement they should go on. So if we issued 100,000 shares of common stock at par for $800,000 in cash, okay, it goes in the stockholders' equity section of the balance sheet, so it goes in the financing section of the cash flow statement. We borrow $200,000 from Castle Bank, signing a 5-year note bearing 8% interest. Again, that's financing. So we're financing our business. We're borrowing money so we can use that cash. So we're going to show that cash inflow in the financing section. We purchased 2 semi-trailer trucks for $170,000 cash. That's going to go in the investing section. So we're investing into our business. Our property, plant, and equipment is going to increase. That cash flow out goes in the investing section. We paid our employees $12,000 for salaries and wages. That's operating. Again, we record the expense on the income statement, and the income statement items go into the operating section of the cash flow statement. And then we collected $20,000 cash for services performed. Again, income statement item goes in the operating section. Now we'll talk about how we create or prepare the statement of cash flows using the indirect method. There are 3 sources of information that we use to be able to complete the cash flow statement. We're going to use the comparative balance sheets. So it's the balance sheets at the beginning of the period that we're dealing with and the end of the period. So most of what we're looking at in the examples here will be for the year, so it'll be 1 year versus the second year. The current income statement, so it's the income statement for the same period that we're doing it. So if we're doing it for a year, we need the income statement for that year. And then we need some additional information that we can't get off of the balance sheet or the income statement. So that is going to include things like selling or buying plant assets, issuing stock, paying dividends, that type of stuff. So we'll see examples of those as we go through. 3 major steps that we do. We determine net cash provided or used by operating activities. We do that by converting our income statement, our net income, from an accrual basis to cash basis. So it's basically turning everything back into cash. So we analyze not only the current year's income statement, but also the comparative balance sheets and any selective data that might be helpful as well. Step 2, we analyze the changes in non-current asset and liability accounts and stockholders' equity accounts. Report as investing and financing activities are disclosed as non-cash transactions. So we're looking at property, plant, and equipment, intangible assets section. We're looking at the long-term investing section of the asset side of the balance sheet. Then we're looking at the long-term liabilities, notes payable, bonds payable, that type of thing. And then the stockholders' equity section, common stock, paid in capital, dividends from the statement of retained earnings that's into retained earnings. So we're looking at all those things in the balance sheet on what happened, and then most likely additional information to help explain what those differences are. Sometimes just looking at the difference, we can make an assumption of what happened, but having that additional information will clarify it and make sure we can classify it on the cash flow statement correctly. And then finally, we compare the net change in cash on the statement of cash flows. So after we do the 3 sections, we add that up. It says the cash change for the period. We compare that to our beginning, or we add it to our beginning balance, and that should be the same as the ending. So our cash flow statement should equal the difference in cash between the 2 balance sheet dates. So we said we're going to use the indirect method. So we're adjusting net income for items that do not affect cash. 2 reasons why we do this, and most companies use it, versus the direct method. So the indirect method is easier and less costly to prepare, and it focuses on the difference between net income and net cash flow from operating activities. Whereas if we use the direct method, and companies could do this if they wanted to, it shows operating cash receipts and payments. So every transaction, not only do they have to record it on an accrual basis to make sure that their income statement and balance sheet is correct, they then have to look at what, if we recorded that as a cash basis, what that would be and what the impact of cash is for each item. So we adjust each item in the income statement from the accrual basis to the cash basis. So it's really looking into each account of was it a cash transaction or not, and it just takes a lot of time to do. It's more costly because you're almost keeping 2 sets of books as you're doing it. Again, you can do it because it's going to give you the same answer. The indirect method just is easier and less costly, so that's why companies use it. So we'll start looking at some data and go through some examples. So we're going to use the comparative balance sheet. So we have 2 years, 2027 current year, 2026 the prior year, and then for each item in the balance sheet we show if it's an increase or decrease. Be careful as you're going through examples and problems and homework and the exam to understand which column is which year, so you don't get messed up and an increase is showing as a decrease or something like that. Typically when we see comparative balance sheet like this, the first column is the current year, the next column is the prior year. But I know in some of the homework and stuff, they don't show a comparative balance. They just say what the balances are. So just make sure you know which is year 1 and which is year 2 when you're doing the difference to get the increase or decrease. Here is the income statement for that same year, for the year ended December 31st, 2027. So we have our sales revenue, cost of goods sold, operating expenses. They broke out depreciation, so we have that different. That'll be important as we go through this. We have a loss on disposal of plant assets, so we'll talk about how that gets handled on the cash flow statement as well. And then our income before income tax expense, and net income. And finally, we have additional information. So it tells us that our depreciation expense of $9,000 that was on the income statement, $6,000 for building, $3,000 for equipment. We sold equipment with a book value of $7,000. So cost of $8,000, accumulated depreciation of $1,000. We sold that for $4,000 cash, which is at a loss, which is why we saw that on the income statement. We issued $110,000 of long-term bonds in direct exchange for land. A building costing $120,000 was purchased for cash. Equipment costing $25,000 was also purchased for cash. We issued common stock at par for $2,000 cash, and we declared and paid a $29,000 cash dividend. So we'll attack the operating activities section first. So we're going to determine net cash provided or used by operating activities by converting net income from accrual basis to cash basis. So we're going to start with net income, and then we're going to add or subtract the adjustments to get our net cash provided or used by operating activities. The adjustments are, we're going to add back non-cash expenses. So depreciation expense is the most common. If we had amortization expense from a non-tangible asset, that type of thing, those are non-cash transactions to get those expenses. So we add those back to net income. Because it decreases net income, we're going to increase it back because we didn't actually pay cash at that time. Then we're going to deduct gains and add losses resulting from investing and financing activities. So if our income statement shows a gain, we're going to subtract that. If the income statement shows a loss, we're going to add that back. Okay. Reason is we're going to account for the cash in the investing and financing sections, so we don't worry about the gains and loss, even though we have to report that on the income statement. So we deal with that in a different section. And then finally, we're going to look at the non-cash, so that means it's not the cash account, current assets and current liabilities. Those are the things that from the balance sheet side, they flow through the income statement on the income statement side. So we're going to explain those differences, those increases and decreases, and how that affects cash. Quick review question. Which is an example of a cash flow from operating activity? Payment of cash to lenders for interest, receipt of cash from the sale of capital stock, payment of cash dividends to the company's stockholders, or none of the above? The answer is A, payment of cash to lenders for interest. So the payment of interest, the receipt of interest is in operating. The borrowing of the money and paying back the money is in financing or possibly investing. Receipt of cash and payment of cash dividends both go into the financing section. So now back to our example. We start with adding back our non-cash items on the income statement. So we start with net income from the income statement. We're going to add back depreciation expense. So that's the first thing we always do on a cash flow statement. Net income plus depreciation. Losses and gains on disposal of equipment. So the cash received from that sale is reported in investing, in the investing section. Because we do that, we eliminate all the net income. We eliminate from net income all gains and losses related to that disposal, so that when we're talking about cash provided by operating activities, that gain or loss is not really an operating activity, so we adjust that. If we have a loss on the income statement, we add it back to net income on the cash flow statement. If we have a gain on the income statement, we subtract it from net income in the operating section of the cash flow statement. So we just do the opposite of what it is on the income statement on the cash flow statement. So we had a loss on disposal of plant assets of $3,000 on the income statement. We saw that a few slides ago. So we add that back to net income, just like we're adding back the depreciation expense. Now we look at the non-cash current assets and current liabilities. So accounts receivable. When accounts receivable balance decreases, cash receipts are higher than revenue earned under the accrual basis. So we're summarizing what happened in accounts receivable. We started with a balance of $30,000. We had sales revenue of $507,000. We assume that was all on credit, so it goes through accounts receivable. So we debit that accounts receivable, that amount. We collected $517,000 from customers. So it's more than what we had in sales revenue. So we collected some of that beginning balance. Our ending balance is $10,000 less. So that means we received more cash through this account. So we're going to add that to net income because our accounts receivable decreased. Inventory. When the inventory balance increases, the cost of merchandise purchased exceeds the cost of goods sold. Cost of goods sold does not reflect cash payments made for the merchandise. So the company deducts from net income this inventory increase. If inventory were to decrease, the company adds that to the net income. And any prepaid expenses. Same thing, when the prepaid expenses increases, cash paid for expenses is higher than the expenses reported on the accrual basis. So we deduct the increase from net income. If prepaid expenses decrease, reported expenses are higher than the expenses paid. Therefore, the company adds that to net income. So here's how it looks on the cash flow statement. Decrease in accounts receivable, we add back. Increase in inventory, we subtract. And increase in prepaid expenses, we subtract also. We got the information from the comparative balance sheets. So here's the decrease in accounts receivable, increase in inventory and prepaid expenses. So straight from here, we can put it onto the cash flow statement. Next, we look at the changes in current liabilities. When accounts payable increases, the company received more goods than it actually paid for. The increase is added to net income. When income tax payable decreases, income tax expense reported on the income statement was less than the amount of taxes paid during the period. That decrease is subtracted from net income to determine net cash provided by operating activities. Again, here's what it looks like on the cash flow statement, and a reminder of where that information came from, the comparative balance sheet. So here's a summary. This is a great chart to keep in mind, maybe keep with you as you're going through the homework to help understand this. We start with net income. We're going to add back depreciation expense and the amortization expense on the income statement. Any loss on disposals we'll add back, any gains we'll deduct, and then the non-cash current assets and the current liability accounts. We deduct increases in current asset accounts, add decreases in current asset accounts. On the liability side, we add increases in current liability, and we deduct decreases in current liabilities. Another way to remember what we do with the current asset and current liability accounts is to think about what is going on in that account. So an increase in a current asset account gets the current assets increase with a debit. If we assume that the other side was cash, if we debit current assets, we're going to have to then credit cash. Credit to cash is a decrease in cash. So if you just think about that of if cash was the other side, what causes that increase or decrease is a debit or credit. Cash is the opposite, debit or credit. If it's a debit, we add it on the cash flow statement. If it's a credit, we subtract it or deduct it on the income statement. So it's just another thing to think about that might help you understand better. Otherwise, just memorize this increase in assets is deducted, decrease is added, increase in liability is added, decrease in liability is deducted. So do another example here. Josh Photo Plus reported net income of $73,000 for 2027. Included in the income statement, depreciation expense of $7,000, gain on disposable plant assets $2,500. The comparative balance sheet shows accounts receivable and accounts payable and their changes. Calculate net cash provided by operating activities for Josh's Photo Plus. So we're going to start with net income, $73,000. We add back depreciation expense of $7,000. We had a gain on disposal of plant assets. So what do we do with that gain? We're going to deduct the gain in the operating section. And then we have comparative balance sheet. So I pointed this out before, but here's an example. 2026 is on the left, that's year one. 2027, the year we're creating the cash flow statement for, year two, is on the right. So it's not a comparative balance sheet in the sense that the current year is listed first, like we saw in the other example. So just be aware of what it is. So in this case, accounts receivable went from $17,000 to $21,000, an increase. So we have an increase in accounts receivable. We have a decrease in cash. Accounts payable decreased from $6,000 to $2,200. So that difference, that decrease, is going to go as a subtraction. And here's what the operating activities section of the cash flow statement will look like. Now we'll look at the investing and financing activities. So we're going to analyze changes in non-current asset and liability accounts and stockholders' equity accounts. That's going to be reported on these investing and financing activities or possibly non-cash activities. This company purchased land of $110,000 by issuing long-term bonds. This is a significant non-cash investing and financing activity. It will be disclosed separately. From the additional information, the company acquired an office building for $120,000 cash. It's a cash outflow reported in the investing section. The additional information explains that the equipment increase, $17,000, resulted from two transactions. Purchased equipment for $25,000, and we sold equipment costing $8,000 for $4,000 cash. And we have the entry of the sale of the equipment. Common stock, $20,000 increase in common stock resulted from the issuance of new shares of stock for cash at par. This is reported in the financing activity section. And the retained earnings increased $116,000 during the period. Two factors for that: a net income of $145,000, and then it got decreased by the $29,000 of dividends. So that decreases retained earnings. That payment of the dividends is a cash outflow. The company reports as financing activity. Now remember, when we talked about dividends, there's a declaration date, and we do an entry and set up the liability. That's a non-cash transaction. So if we declared it in December, for example, not paying it to January or February, and now we're at the end of December doing this, that would be a non-cash activity that would be disclosed. When we paid it, that's when we actually show it on the cash flow statement. So using that information, adding it to what we had done for the operating activity section, this is what the cash flow statement would look like for Computer Services Company. So under investing, we have the purchase of the building, the purchase of equipment, and then the sale of the equipment. Under financing, we issued common stock, so we received cash for that. We paid dividends, $29,000, so that's an outflow. So we net increase in cash was $22,000. We added to cash at the beginning of the period, $33,000, $55,000 cash at the end of the period. And then issuance of bonds to purchase land is disclosed at the bottom as a non-cash transaction, which is an example of a cash flow arising from an investing activity. Receipt of cash from the issue of some bonds payable, payment of cash to repurchase outstanding capital stock, receipt of cash from the sale of equipment, payment of cash to supplier for inventory. We're looking for the investing activity. Oops, sorry. So receipt of cash from the sale of equipment is investing. First two are financing, so it's how we're financing our business. And then the last one, payment of cash to suppliers, will be in the operating section. Now we're going to look at the net change in cash. So did our cash flow statement. We saw that there was $22,000 increase in cash. We're going to compare that to the change in the cash account reported on the balance sheet to make sure they agree. So we're using the comparative balance sheet. The $22,000 that we came up on the cash flow statement does equal what we saw on the balance sheet. So that $22,000 increase here, and we look at it here in the cash flow statement. There's the $22,000. We add it to our beginning balance to get $55,000 ending balance, which is what we're showing on the balance sheet. So that proves that we accounted for everything the correct way, cash inflows and outflows. Does not mean that we did the cash flow statement correctly, because if we put a investing activity in the operating section, the cash flow statement's wrong, even though the total is correct. So it's a good check to make sure our total's right. We have all our increases and decreases, cash inflows, cash outflows going correctly, but it doesn't mean that we have each section correct. So we'll do another example. We've got a comparative balance sheet. We're going to create a statement of cash flow. So here's our comparative balance sheet, or comparative. We have our income statement, and then we have additional information. And we're going to create the cash flow statement. So again, we start with net income. We add back any depreciation or amortization expense. If we look at the income statement, we don't see it on there. So we have to look at the additional information. And it says, yep, here it is, depreciation expense $33,000, $10,000 for the building, $23,000 for equipment. So we're going to add that back. Doesn't say we have any amortization, so we don't have to worry about that. If we look at the income statement, we have a loss on disposal of plant assets of $2,000. So we're going to add that back to net income. Then we would look at our comparative balance sheet, at our non-cash current assets and our current liabilities. So our accounts receivable, our inventory, prepaid expenses. Did they increase or decrease? And then accounts payable, accrued expenses payable, increase or decrease in those. And we got to know how we handle those. So remember, increase in an asset is cash outflow, decrease in an asset is cash inflow, decrease in a liability is cash outflow, increase in a liability is cash inflow. So we can arrange those differences on the cash flow statement. Then we're going to look at investing and financing. So land was sold at its book value for cash. So it doesn't tell us any numbers, so we have to go back to the comparative balance sheet and look at the land account. So it went from 70,000 to 45. So that decrease is going to be cash in. So add $25,000 in that investing section. Cash dividends declared and paid, that goes in the financing section, so as a cash outflow. Equipment with the cost of $166,000 was purchased for cash. So that transaction itself is a cash outflow, $166,000 in the investing section. Equipment with the cost of $41,000, book value of $36,000 was sold for $34,000 cash. So we had a book value of $36,000. I thought that said depreciation at first, so I had to make sure. So cost of $41,000, book value of $36,000. We sold it for $34,000, so that's that $2,000 loss we saw. But on the investing section, we don't worry about the gain or the loss. We took care of that in the operating section. All we care about in the investing section is the cash. So we received $34,000 cash, so we're going to show that as cash inflow. Bonds of $40,000 redeemed for their face value of cash. So that's in the financing section, showing that cash outflow. And then common stock issued at par for $160,000 cash. That's cash inflow in the financing section. So if we did the cash flow statement and all that, here's what it would look like. So we have cash provided by operating activities of $59,000. We had cash used by investing, $107,000. Cash provided by financing, $65,000. Gives us an increase in cash of $17,000. Our cash at the beginning of the period was $37,000. So our cash at the end of the period should be $54,000. And if we go back to the comparative balance sheet, we see that $54,000 here. So we've accounted for our increases and decreases, our inflows and outflows correctly, and we balance back to the balance sheet. And then finally, we'll analyze the statement of cash flows. So the key measure that a lot of companies use is free cash flow. This is a non-GAAP measurement, so it's not, you can't use it for GAAP, so they have to show this calculation that we're going to talk about in their notes to their financial statement if they use that free cash flow, but it is a good measure. So we're going to start with the net cash provided by operating activities, so that section of the cash flow statement. Then we're going to subtract capital expenditures, so where we spend money in buying the plant assets, land, that type of thing. And then we're going to subtract any cash dividends paid. So if we look at Apple for 2021, this is their summary of cash flow statement. It doesn't show the details, but it shows net cash provided by operating activities. Then it shows cash flows from investing. So what we have here is, and then at the bottom, cash paid for dividends as well. So it doesn't say the whole section, but that. But we take our cash provided by operating activities straight from the statement. We're going to subtract expenditures on property, plant, and equipment. So the $11,085, we see that here, payments for acquisition of property, plant, and equipment. And then we subtract dividends paid. That's from the financing section. And we get free cash flow of $78,486. Let's see if we can do that on our own here. So Chicago Corporation. We have our cash flow statement, and we need to compute the free cash flow for Chicago Corporation. So we start with our cash provided by operating activities, $29,300. We're going to subtract any cash paid for property, plant, and equipment. So they show a purchases of equipment here, $19,000, so we're going to subtract that. Then we subtract any dividends paid, Down here we say payment of cash dividends 9,000. So when we look at the free cash flow for Chicago Corporation, 29,300 minus 19,000 minus 9,000 is 1,300. And then why is free cash flow often provides better information than cash provided by operating activities? The reason is that net cash provided by operating activities does not take into account that the company has to invest in new plant assets to maintain the current level of operations. So they also must maintain dividends at current levels to satisfy investors. So if we take cash from operating activities, subtract our investment back in the business by property, plant, and equipment, and paying our shareholders through dividends, that gives us a better idea of our true cash that we have and what the cash generating ability of the company is. So that's why free cash flow is used. That's it for Chapter 12. And that brings us to the end of our semester for Accounting 101. As always, if you have questions, please reach out as you are finishing up your homework and your assignments and preparing for the final exam. Don't forget all the resources we have. You can reach out to me. You can go see the tutors in the tutoring center. There's a lot of resources from Wiley that you can access through Blackboard. And then there's the 5-Minute Accountants also, if you want to look through Blackboard and specifically see some of those. In some of the previous chapters, I have posted some kind of challenge exercises. So if you want to go through those to help you on those chapters, those are out there as well. And again, reach out if you have any questions. Thank you.